Is it worth buying Fiverr stock? What are the main risks and forecasts for the company? Fiverr is a freelance marketplace where freelancers are sellers. They can post their services to prospective buyers. Basically, Fiverr serves as e-commerce platform to freelancers and companies to sell their services by using their gigs. The company earns by charging a 20% commission for completed tasks. Despite this, the company is unprofitable. Just like all internet companies, Fiverr has been one of the beneficiaries of the pandemic, and the company significantly increased its revenue in 2020. But it's not because many people just switched to remote work because of the lockdowns. No, it doesn't matter that much how many people are working on the website. For the company, I mean. The number of buyers matters, and how much money they spend matters. Too many sellers cause high competition between them and makes it harder for buyers to choose a freelancer. Because when you have a choice between two, it's easy. When you have a choice between 100, it's hard. So sellers just choose a freelancer with the best reviews. A very small percent of sellers just monopolize the flow of others and just make all the money. 70% of sellers make less than $100 per month. 96% of sellers make less than $500 per month. And only 1% of sellers make more than $2,000 per month. The sellers that make more than $500 per month make 58% of the company's revenue. So it doesn't matter for the company if the number of sellers is increasing. On the contrary, fewer sellers means less competition between them, so there will be higher prices and higher commissions. The point is, if you want to invest in Fiverr, you should believe that the demand for those gigs will increase in the future. You should believe there will be more buyers in the future and they will spend more money for the gigs on Fiverr. So far, the number of active buyers increases, as well as Fiverr annual spend per buyer. According to the forecasts, it will continue to increase, so the company's revenue will continue to grow. The current company's market capitalization is $2.5 billion. Price to book ratio is 7.6, price to cash 6. The company has a significant debt, price to sales 9.3. It still looks expensive because the company is unprofitable. Half of the shares owned by retail investors, they like this kind of stocks, so they inflated the price too much that it still looks expensive after more than 70% correction. Just compare it to Pinterest. The revenue is growing at the same rate, but Pinterest has lower ratios, it's a profitable company unlike Fiverr, and has no debt. The market doesn't make any sense anymore, I think. The company's main competitor is Upwork, another freelance website, but the main risk is that the company is unprofitable and has a debt that increases over time. It's not the worst idea to invest in Fiverr, but they're just bear stocks. That's all, thank you for listening.